Hello, I'm Afsaneh Beschloss, CEO of RockCreek, meeting you today from Washington together with our eminent senior advisors, Dr. Alan Greenspan, one of the longest serving chairman of the Fed, and currently working very hard on his book on the economic history of the US. Also with our other eminent advisor, Liaquat Ahamed, who not only has been the CEO and CIO of a major investment group, but also is a historian and author and well-known, respected for his Pulitzer-winning book, The Lords of Finance. So it's a very interesting time to be having our quarterly call, and I am very much looking forward to hearing from both of you on a number of questions. Dr. Greenspan, you were the person who, before anyone else was talking about Korea, it might have been even like 2 years ago almost, more than a year and a half ago, started telling us to watch Korea. You were worried about the risks of Korea.
I think that you have to realize where North Korea is coming from. And unfortunately, the problems are that while it may appear as though we're getting close to some sort of agreement and to denuclearization and all those fancy terms which don't necessarily mean very much, the problem is that you've got to find a solution to which would basically lock the United States and North Korea into a more coherent whole. The only problem is that no one is really given much thought to how that can happen. And what we have to do is the following. We basically got to the point where North Korea is saying, well, I think they got scared that they may have gone too far. So they backed up, but they're still looking for the issue of what do we get out of this. The difficulty is that you've got a situation out there which is extraordinarily volatile. Ideally, you could say, well, what's in it to cut back? And I think you have to, there's several facts which I think are really important and must be recognized. One is, what does Korea look like from a satellite at night? And I don't know if either of you have seen that picture. It is fascinating. You can literally see the lights on in South Korea, and as you get to the DMZ and beyond, it's black. That says they have no electric power, they have no GDP to speak of, and everything is essentially a small, very small economy. And the question is, what can they do about it? And the one thing which would be obvious is we can find ways to help North Korea become a vibrant South Korea type economy. The only problem is they have to break their regimes in part, because you cannot have a 21st century economy which is not which is not functioning. In order for North Korea to become a functioning economy, they're going to have to turn towards capitalism. This is, remember, not a capitalist society. In fact, it's the worst of all possible worlds. It's a monarchy. I mean, they go from one generation to the next, and it's violent. So I don't see how we can fundamentally construct something which will be acceptable to North Korea. In fact, I know we can't. The only thing we could do is to help have them set up and replicate South Korea, but South Korea is a market economy, and North Korea would have to dissolve its political system and the power of the family to get something done. That is not going to happen. They're going to continue. The only thing they've got is their nuclear and missile capability. It's a very intelligent group of people who put this all together, but it's a totalitarian state, and you cannot get any economic growth from a totalitarian state.
But do you give it any probability that they might actually move towards a market economy with the Chinese, who seem to be very involved in this whole dialogue?
You can't do that and maintain their existing political structure. There's no way, it is not consonant. Strangely enough, China is far more, well, actually China 20 years ago was actually a capitalist economy. I mean, I used to deal with them all the time, and Zhu Rongji, for example, the prime minister, knew more about capitalism than I did. I mean, so I would,
They've done a pretty good job with their economy.
I mean, I suppose there's one risk, which is the whole thing blows up, that there are misplaced expectations on both sides. I do have a slightly more positive slant on it than Alan, that there may be a chance that the leadership in North Korea have looked at those photographs, those satellite photographs that you've talked about, and said, we actually do have to change. And that they realize that they are in an unsustainable position and are looking for an opening to get sort of, get the beginnings of economic growth going. So I'm a little more positive about what may happen.
Well, aren't you concerned that they're going to try to hold on to power? That's all they got. And I mean, I grant you that they have a terrific potential to do something here, but it really means essentially abandoning the totalitarian state they have.
Or loosening it. Not, there's some idea that they could.
Well, I hope you're right. I'm not sure how they would know how to do that.
We've been telling our European allies that we're putting on tariffs on aluminum and steel. Going into this G7, what do you expect? Do you expect anything major to come out of it, or both of you?
This is a bizarre situation. Essentially, Trump is focusing on what he would like as an American economy. Mm-hmm. It's called the economy of 1955. That economy, real per capita income, was 1/3 of where we are today. And it just so happens that China, the biggest competitor, has a real GDP today, which is 1/3 of ours. So in effect, China is living back in the days of steel, aluminum, heavy industry, and what Trump is essentially saying, let's go back. In other words, go to a society which is less formidable. And of course he never says that, right. doesn't even know it exists. But that's what the problem is. It's a different civilization. He is focusing on how would you resolve the issues of basically the American economy from western Pennsylvania through to Iowa, which used to be the vibrant part of the economy, and that is basically subdued very considerably.
Interesting, though, in all of these trade issues that have been coming up now, I was reading that the Chinese are buying steel and aluminum plants outside China so that it would not get affected by tariffs by anybody. So it seems like they are investing in their AI and machine learning and technology and biotechnology, but they're sort of learning the lesson that that's the way to go.
We have an economy now in which, if you look at versus China, the trade issue is basically U.S. and China. China is the major exporter. We are the major importer, and it's for goods. It's remarkably dominant. Those are the two forces, and so you've got a situation where the United States is trying to figure out how to make this issue come together, and there is no simple solution as it stands now. And so why would we want to go back to an earlier stage? And the answer is that's where the political base of Donald Trump is. And he is a good politician. I must admit, he pulled it off, and it's an extraordinary thing. He's done some things which I think are actually quite good, but that's basically he's got the people who are advising him. But in general, I don't think he understands how the system works.
Liaquat, what do you think is we're going to sort of see in this meetings?
For the reasons that Alan outlined. The whole trade issue makes no economic sense. And so luckily, though, it's a tiny, we're not in a trade war yet.
So you don't think technically we're in a trade war?
No, this is too...
Talk war, not technical war.
The orders of magnitude are too small to call it a war. Maybe you call it a skirmish, maybe you call it, the initial shots of a war, but and that's good. That I don't think it has the potential at the moment to derail a global economy, which is actually doing pretty well. And since it doesn't make any economic sense, you have to say it must be being done for political reasons, and grabbing the headlines by saying, I am attacking foreigners because all of our problems are due to an unfair trading system, probably gets him some votes in certain areas. So I don't think anything will come of the trade war, but I think we've ended up angering our allies, because we've not only picked a fight with China, we picked a fight with the Europeans and with Canada. So this does not bode well for sort of global cooperation. On the other hand, despite all that, the global economy, and particularly the U.S. economy, is on fire. I think we're going to get 3% plus growth this year.
Despite all this uncertainty about what's going to happen with trade or other things,
Profits started going up. Profits were stagnant 2014, 15, 16. Started taking off. They went up 20% in 17. They look as if they're going to go up another 20%. Part of it was the tax cuts. Part of it was the accumulated effect of all of that stimulus over the last few years. And that is what's driven financial markets and has totally sort of swamped the negative effects of the politics.
And Alan, when you look at the tax cuts that we just had, looking at the positive and the negative, where do you fall on those taxes?
Well, I ask myself, where did the tax cut structure come from? Right. It's called Ireland. The Irish, remember, had basically a marginal corporate tax rate of about 35%. And they had enough sense to realize that being at the bottom of the heap, in order to move, they had to attract new industries, new companies alike. And what they did is they cut the corporate tax rate, as we did, or I should say that we followed them, from 35 to 12%. When you remember, we're looking at the bottom line. We're not looking at a complex cost structure. It's dollar for dollar. You cut pre-tax profit. You're given pre-tax profit margins, and the tax rate will determine what your after-tax return is. And the Irish experience was really dramatic, and I don't know where the numbers came from in the Trump tax cut, but they look remarkably similar, and I have to assume, either by accident or by good chance, they chose it because we are beginning to get the same effect that they do. And the reason it's important, this is not like inspiring, in other words, inspiring investment and a variety of other things. This is really down at the bottom line. Every dollar you take out of taxes, you add back to after-tax income. So the figures look good. I'm a little less sanguine about the outlook than Liaquat, but we're approaching 3% in the data for the second quarter. Third quarter is a mix, and the book I wrote before the one that's coming out now basically took the position that we were crowding out our gross domestic savings, and that gross domestic savings is the key to capital investment and economic growth. And entitlements, if anything, are expanding. So I think it's we just forget the gross domestic savings and a lot of complex relationships. Just look at the personal savings as a percent of disposable income, which was 10% 15, 20 years ago. It's now down to 3-4%. Now, we have taken, the entitlements have gone from 4% of GDP to 14% of GDP. You cannot take 10% of the GDP out of an economy without extraordinary negative impact. And I think we're seeing that, and we have seen that for quite a while. You're certainly right, the economy is doing better now, but I think that's basically the tax cut and deregulation, which has had also an important effect. But I find it very unlikely that we can go 3% continued growth, largely because entitlements are beginning to squeeze out gross domestic savings. If you don't have gross domestic savings and you cannot borrow the funds from abroad, remember, we have built up an $8 trillion deficit on current account since the last 15 years. Now, that is running into trouble. You can see that people are not wanting to hold U.S. treasuries. This is the most unusual forecasting period I've run into in a long time. I wish I was as optimistic as Liaquat, but
well, no, let me clarify. I'm optimistic in the short run because of the combination of the tax cut and the budget stimulus. Mm-hmm. And it's rare to have that when you're this close to full employment. And the strange thing is, this hasn't shown, you might have thought this would show up in inflation.
And why do you think it's not showing?
Beats me.
You know what it is? It's the issue you were raising later. It's the question of demographics.
Right.
I tell you, I have data going all the way back to 1789 in the United States. And this is the period of lowest inflation in American history. When I stick that relationship I forecast inflation basically by first tying it to unit labor cost, or I should say unit money supply to be exact. And unit money supply is a remarkably close forecaster, but in the last several years it has veered off. And I don't know whether it's explainable by the BIS insights, but they certainly do fit. So I'm inclined to believe that what it says is for the long run is inflation will eventually pick up, long-term interest rates will pick up. It raises very interesting questions about equity markets because you've got the combination of rising profits on the one hand and serious financial problems on the other. So it's one of the weirdest periods I've been in a long time.
But when you look at wages and labor, for example, Walmart, I think, was the company that is now letting large numbers of their workers get free education, college level education, right? Other employers are giving people special bonuses and things like that. But this does not then show up in your labor cost, right? The fact that they're spending money on their workers' education.
The point at issue is from an individual corporation. They link them because that's
for them in their accounting.
Yeah, but the unit labor cost and the unit money supply are the officially used data. In other words, you look at unit money supply, it fluctuates like this, and the price level goes. Milton Friedman was right that inflation is everywhere and under all conditions a monetary phenomenon. And the basic trend of way economies are functioning is very much related to the money supply in the system, but only up to a point. And and it's been extraordinarily off message, so to speak, in the last 4 or 5 years.
So, what is your forecast for inflation?
Inflation will start to accelerate, and I think it's already starting to accelerate. I think it's got a good way to go on the upside.
And what do you agree? Or
yeah, no problem. Look. When I said I was surprised, I was surprised it hadn't occurred.
Or not, or very little.
Or very little. We've gone from 1.5 to 2.
Right.
But looking forward, I think it's just hard to be at 3.8% unemployment.
Right.
And not eventually, and all of these anecdotes about corporations scrambling to get workers, I think eventually shows up in raising prices. And maybe at the moment they're scrambling to get workers, but they don't feel in a position to pass it on to consumers, and they will start passing it on to consumers. The Fed is going to tighten much more than the market is discounting, and as a consequence, we're going to go through a standard business cycle. There's a good chance that the Fed is raising rates at the end of next year above 3% to 3.5%, 4%. And the economy starts feeling the effects, and that the business cycle asserts itself coincidentally at the next election.
Interesting. Interesting timing.
Right.
So one of the things that I thought it would be great to get your thoughts on is Dodd-Frank, Volcker. What we're finding interesting in RockCreek is that we invest in private lending and credit, and in the private lending area, there's so many opportunities, and they don't seem to be going away. And these groups are taking away the business from the banks, and the banks are not yet there to be doing what banks are supposed to do, which is lending to businesses. Do you think that as the regulation sort of gets, is it going to be a good balance, first of all, because you need at least to keep the banking system safe, but secondly, are they going to come back and do the business they're supposed to be doing?
Let's put it this way. I have a view which every banker friend of mine thinks is traitorous. I think that what we now have, we have enough information going back into the last century to indicate that the necessary and sufficient conditions for a crisis is a toxic asset which is funded in a highly leveraged situation. And we can see, going back now, we now have the 1929, 2008. We've got there are actually very few incidences, because it's the problem with this. But they all seem consistent with those two requirements. Instead of going to Dodd-Frank after the 2008 crisis, I've argued, and I would do so in this book as well, that we should recognize that it's contagious defaults that are at the root of a financial crisis, all the time under no qualification other than that. And so how do you prevent contagious defaults? And the issue is that you significantly raise the proportion of bank or financial intermediary assets that is supplied by equity capital. This basically means that if you look at the non-financial part of the economy, the ratio of equity capital to assets is 45%. You don't get contagious default at 49%. And we have this wonderful series dating back to 1869 for national banks. And what those data show is that from 1870 to date, the rate of return, merely, let's say, net profit to equity assets, has been 5 to 10% virtually every year. In the Great Depression, it went out of sync for a year or two, but it came right back. We are right where we were in 1869. Now that is extraordinary, because at the same time this pattern of flatness occurred is a time in which we had a dramatic decline in the proportion of the amount of let's see the best way to put it was equity capital used to be extraordinarily high. You couldn't get a bank to function without extraordinary changes, so that the equity capital requirement in the United States through the 19th century is going down very dramatically, and then up a little bit at the same time that the rate of return on equity has been stable, and indeed that 5% also shows up in the rate of return on all equity. In other words, if you look at corporate profits going back and the rate of return, it's that same 5 to 10%. Now, unfortunately, we don't have data going all the way back to 1869, except, so my recommendation, as you can see why the bankers love me, is to raise capital requirements in the financial intermediary to 30%, 35%. The rate of return on equity won't change. But there will be somewhat less lending. That's precisely the lending you didn't want in the first place.
What do you think?
So I essentially agree with Alan that Dodd-Frank tried to imposed all of these very onerous regulations on behavior, which are incredibly difficult to police, particularly when some of the regulations are not what you do, but why you did what you did. Right. And it's very hard to regulate things based on people's motivations. It did raise equity capital requirements on financial institutions, but very modestly. Yeah. And Alan is dead, and Alan and a whole group of people have been saying you should have gotten rid of all of the behavioral regulations and you should have just trebled capital requirements or quadrupled them, and that didn't happen. So one day we will have another financial crisis because capital is not adequate, but I don't think that's going to happen in the next couple of years. There's a fundamental problem, which is you impose capital requirements on banks, and someone starts something which they don't call a bank, right, but for all intents and purposes is a bank, and starts doing banking business. Right. And people basically skirt regulations, including capital requirement regulations, and it's you're always chasing a moving target. So I worry about the level of all of this hype with direct lending that currently exists.
And in addition to direct lending, by the way, and some of our venture investments, what we're seeing is companies that are replacing mortgage companies by, you want to get a mortgage, I'll co-own the house with you, and I will own a piece of the mortgage
that's
with you.
That's sort of okay, because that's people are, they're taking on equity risk.
Right,
and
exactly.
So I'm actually fine with that. So I'm not against sort of financial innovation of that sort. But look, I don't think the next crisis is not going to be a repeat of the last crisis.
Right. Right.
So I don't think we are going to have a mass of defaults and shadow banks. Maybe that's the crisis after the next one.
You look farther into the future than anybody I know.
So we have the meeting coming up. Our house view is that there will be an increase, but also that the market is underestimating future increases. And everyone is assuming very orderly 25 basis point increases in the next year, but that could be an underestimation. What are your thoughts?
So we're currently at 1 3/4.
Right.
2%, so another 25 basis points is baked in the market is expecting one more move to 2 1/4 by the end of the year. So it really only ever got to sort of 3. For a while it flirted with the idea of 4 rate hikes this year. It sort of stuck with 3. I think they're wrong. So I think, because I'm positive about growth, I think the Fed will probably tighten twice more this year. So we could get rates at 2.5 by the end of the year. What is also striking is the market is expecting Fed funds to cap out at around 2.5. And that, it seems to me, is too low. So I don't know when, but I just think some point in this cycle, the market is going to get very disturbed, and because I think rates are going to cap out at more like 4%. And the market is, where the market is seriously underpricing things is where rates end up going by the end of the cycle.
Europe grew quite a bit last year, more than the market expected. This year, it sort of plateaued a little bit. Mr. Draghi is talking about things being better than expected. What do you think is going to happen in Europe on interest rates and on sort of their
I am very concerned about the euro. People don't spend enough time looking at what is called Target 2. Target 2 is the clearing mechanism for the individual central banks that make up the Eurozone. The trouble with that simple matter, which is we think would have no real importance because it's an overnight clearing system, is that the Bundesbank has built up $900 billion of credits. And coupled with Luxembourg, which is essentially a combination of a steel mill and German bank branches. Those are the two major credit sources. On the liability side, as you would actually expect, is largely Spain and specifically Italy, but also, shockingly, the European Central Bank itself. And so that you have the odd thing, if you consolidate the system, Germany is lending to the ECB. That's what the data showed. Now that is an unstable situation.
Yeah,
so the central problem is Italy. I mean, in Europe...
And you don't worry about Spain and all the
No,
recent
because
changes.
Spain essentially dealt with its problems by taking a 20% wage cut.
Right.
Greece took a 20% wage cut and got bailed out and got a debt restructuring. Italy cannot be bailed out because it's too large. And they've been totally unwilling to take a massive wage cut. And the only way that Italy has not had an increase in its standard of living for 20 years. I mean, it truly is the sick man of Europe. It's incredibly low productivity growth. All of the areas that they were good at have been, essentially, they've lost competitiveness to Asian economies. And so, I mean, it's an insurmountable problem because of the size. And I don't quite know how it plays out, because at the moment it's playing out politically. But at some point, they've got to figure out a way of getting growth going in Italy before the sort of anti-Euro protests in Italy become so great that it just undermines the whole project of the single currency.
And in terms of sort of the European interest rate, do you see
You know, I can't imagine that they are going to be aggressive in hiking rates while Italy, the problem of Italy is hanging over them. So, and the business cycle, they looked as if they were recovering. This year, there's been a growth slowdown. So I think conventional business cycle economics driving interest rates is not the issue. They've got to figure out a solution to Italy.
Moving on to emerging markets, it's another area of interest, and we have just at RockCreek launched a Frontier Fund and a MENA Fund, and it's been very interesting to watch emerging markets because they're within emerging markets. The last 2 years were really great years. This year has been less of a good year, but within this year even, there's such a huge divergence between countries. You have Saudi Arabia and Colombia experiencing really huge, improvements in their equity markets, and you have Argentina and Turkey having major problems. So there's big differences. The other thing that is happening, obviously, is with U.S. interest rates and the impact on the countries that have dollar-driven, dollar-based debt. There has been quite a bit of selling of their emerging market debt in the markets. Sort of looking at emerging markets, I mean, we think that in the long run they're a great place to be. What are your thoughts about emerging markets, particularly given what's going on in the U.S. and Europe? in the rest of the world.
I'm not sure it makes sense to have a category called emerging markets now.
Anymore.
Yeah. The differences between them are as great as the differences between them and developed markets. So the idea that, you can lump all these guys together and that their assets are going to move together is probably a relic of the 80s and 90s.
Brazil and South Africa?
Right. Yeah, exactly. And so
You're absolutely right. Also, China is going to probably become its own separate category.
And, the problems that we're seeing in Argentina and Turkey are very specific to countries that have large current account deficits, have borrowed too much in dollars, but that's not true about all of the countries. So I think the right strategy is to sort of disaggregate this and make judgments about individual emerging markets. Will rising U.S. rates put pressure on emerging market currencies? Probably yes. That we will get rising rates, we will get the dollar probably rising, and as a group that probably puts some pressure on their currencies. That's probably not all bad for them. So.
And Alan, what do you think in terms of sort of either the broader category or like in China, which you have been a student of for a long, long time?
We are at a point where no one has been before, but China is still only a third the way there. But there's no question that the size is horrendous. I mean, even at 1/3 per capita less, the populations are so much larger. And there's no doubt that the quality of what the Chinese do is improving immensely, but unless the IMF data are grossly wrong and their per capita estimates are significantly askew, there is a real gap to be closed yet, and they're nowhere near. It's not in the immediate horizon.
I think the thing is, China is 3 economies in one. There's the old traditional agriculture, which is what keeps them poor. There's this industrial to use Alan's reference, this industrial 1950s steel and aluminum economy. And then there's this high-tech economy. And it's sort of juggling all 3. And I suppose when Alan talks about disappointment, he is struck by how much of the old public sector economy has been allowed to persist. But you go to China, and what is striking is the dynamism of the technology economy.
I remember when I first went to Beijing, you used to get on the streets and there were only bicycles. And, they often were at the red light, or so to speak, you have about 10 bicycles, of course. And look at aside from the pollution, China has made extraordinary advances.
But now everyone's got a smartphone, everyone's shopping online. They've overtaken us with some of the things they do in payment system, Alibaba, all of these places.
Right. Well, maybe that should be the subject of a future discussion. And I wanted to thank both of you, as usual, for your great comments and great insight, and look forward to our next talk. Thank you.